Right now, you have roughly 18 months. That's it. 18 months to reposition your portfolio before what could be the largest wealth transfer in modern history. And I'm not talking about some slow, gradual shift. I'm talking about a violent, fast-moving transfer of wealth from the unprepared to the prepared, from the people who trusted conventional advice to the people who understood what was actually happening. Now, I've spent over 50 years studying debt cycles. I called the dot-com crash before it happened. I warned people about 2008 before the dominoes started falling. And I'm telling you today, with the same conviction I had back then, that we are now sitting at stage 7 of an 8-stage debt cycle. When stage 8 hits, and it will hit, conventional portfolios lose 50 to 60% of their value. That's not fear-mongering. That's math. That's history repeating itself the way it always does. But here's the good news. There are exactly 4 investments that survive this. 4, they've survived every single long-term debt cycle for the past 500 years. And in this video, I'm going to reveal all 4, explain why they work when everything else falls apart, and show you exactly how to own them before the window closes. Let's start with something most people don't realize. These cycles aren't random. They aren't unpredictable. They follow a rhythm that stretches back centuries. A long-term debt cycle runs roughly 75 to 100 years. The last one peaked in the 1930s and 1940s. Before that, there were others, and every single time at the end of the cycle, there was a massive transfer of wealth, not to the smartest people, not to the richest people, to the people who were in the right assets. Let me tell you about a man named Richard. I met Richard in 2006. He was 54 years old, a civil engineer, smart guy, hardworking, responsible with his money. He had built up a portfolio worth about $1.8 million, split roughly 60-40 between stocks and bonds, exactly the way his financial advisor told him to, classic conventional wisdom. Now, at the time, I was warning anyone who would listen that we were deep into a late-stage debt cycle. The housing market was over-leveraged beyond anything sustainable. Banks were sitting on mountains of toxic assets dressed up to look safe. The cracks were already forming if you knew where to look. Richard heard me. He actually listened to what I had to say. But then he went back to his advisor. And his advisor pulled up the charts. You know the charts I'm talking about. The ones that show how the market always recovers. The ones that show that beautiful upward line stretching back decades. His advisor told him to stay the course. Don't panic. The market rewards patience, so Richard stayed invested. And for a while, it looked like his advisor was right. By 2007, Richard's portfolio had climbed to $2.1 million. He was on top of the world. He started planning his early retirement. He and his wife were looking at vacation homes. They booked a cruise. He was 55 years old and thought he was about to live the dream. Then 2008 happened. His portfolio didn't dip, it collapsed. $2.1 million dropped to $970,000. That's a 54% loss. More than half of everything he had built over 30 years of working, saving, and investing, gone in a matter of months. Now the market did eventually recover. By 2013, the indexes were back to pre-crash levels, but Richard wasn't, because Richard had been withdrawing from his portfolio during the crash to cover expenses. He had been selling at the worst possible time just to keep the lights on. By the time the market came back, he didn't have enough left to benefit from the recovery. His retirement plans evaporated. The vacation home, gone. The cruise, canceled. He pushed his retirement date to 70, then past 70. Richard is 72 years old today, and he's still working. You know who did retire? His financial advisor. His advisor retired comfortably, right on schedule. Because advisors get paid whether your portfolio goes up or down. They collect their fees regardless. Don't be Richard. That's the lesson. Don't listen to people whose income depends on you staying invested in products that make them money. So let me explain how this machine actually works, because once you understand the mechanics, you'll see exactly why what's coming is unavoidable. The economy runs on 3 things: productivity growth, short-term debt cycles, and long-term debt cycles. Productivity growth is the real engine, the slow, steady increase in how much value we create over time. That part is healthy. Then you have short-term debt cycles. These run about 5 to 8 years. The economy expands, people borrow more, they spend more, prices go up, The central bank raises interest rates to cool things down, the economy contracts, and then it starts all over again. You've lived through several of these. They're normal, they're manageable. But underneath those short-term cycles, there's a much bigger, much more dangerous cycle happening. The long-term debt cycle. Over decades, each short-term cycle leaves behind a little more debt than the one before. The total debt load keeps growing and growing and growing until eventually the entire system is so loaded with debt that it can't sustain itself anymore. That's where we are right now. Total U.S. debt has crossed $90 trillion. The federal government alone owes over $38 trillion, which is about 125% of GDP. The annual interest payment on that debt now exceeds $1 trillion. Let that sink in. We are paying more than $1 trillion a year just in interest. That's more than we spend on defense, education, and infrastructure combined. We're not paying down the debt. We're barely paying the interest on the debt. And the debt keeps growing. So what happens when you reach the end of a long-term debt cycle? There are really only three options. Option one is defaults. People and institutions simply can't pay what they owe, so debts go unpaid. This destroys wealth directly. Option two is restructuring. Lenders agree to accept less than what they're owed. This also destroys wealth, just in a more orderly fashion. Option three is inflation. The central bank prints money to cover the debts, which devalues the currency, which means your savings buy less and less over time. Historically, central banks almost always choose option three. They print, they inflate, because inflation is the politically easiest path. It's a hidden tax. Most people don't even understand it's happening until it's too late. Their account balance looks the same, but their purchasing power has been quietly gutted. This isn't theory. This is a pattern that has repeated for 500 years. In the 1930s, stocks fell 89% from peak to trough. Bonds defaulted. Entire fortunes vanished. In the 1970s, bonds lost 60% of their real value. Stocks went sideways or negative in real terms for 13 years. People who thought they were safe because they were diversified got crushed. But not everyone got crushed. In every single one of these cycles, there were four types of assets that not only survived but actually thrived. Physical gold, businesses with pricing power, short-term government securities, and productive farmland. That's the list. Four assets. They've worked every time for 500 years. And I'm going to walk you through each one in detail. But first, let me give you some quick numbers from the 1970s, just so you understand the magnitude of what these assets can do during a crisis. Gold went from $35 an ounce to $850 an ounce. That's a 24x return. Energy companies with real pricing power saw revenues increase by over 700%. Short-term treasuries provided safety and liquidity while everything else was burning. And agricultural land doubled or tripled in value. Those aren't hypothetical returns. Those are real numbers from real history. And the conditions we're entering now are remarkably similar to what preceded those moves. Before I break down each of the four investments, I need to tell you about Margaret. Because Richard's story shows you the financial cost of getting this wrong, but Margaret's story shows you the real cost, the human cost. Margaret contacted me in 2011. She was 68 years old. Her husband had passed away the year before. They had been a team for over 40 years. They'd done everything right, or at least everything their advisor told them was right. They had about $1.4 million in a 70-30 portfolio, stocks and bonds, standard retirement allocation. When 2008 hit, that $1.4 million dropped to around $800,000. Her husband, who had worked his entire life to build that nest egg, who had sacrificed vacations and luxuries and time with his family to save and invest, he watched it evaporate. The stress destroyed him. He couldn't sleep. His health declined rapidly. Within 2 years of the crash, he was gone. Margaret told me something I'll never forget. She said she would trade every single percentage point of upside she ever earned for the peace of mind of knowing their money was safe. She would have given up every bull market gain if it meant her husband could have slept at night, if it meant he'd still be alive. That's what's really at stake here. It's not just numbers on a screen, it's your health, it's your years, it's the people who depend on you. Bad financial advice doesn't just cost money, it costs lives. So let's get into the 4 investments, and I'm going to be very specific because vague advice is useless advice. The first investment is physical precious metals, specifically gold and silver. And I want to emphasize the word physical. I'm not talking about gold ETFs. I'm not talking about mining stocks. I'm not talking about paper gold or futures contracts. I'm talking about physical metal that you own, that exists in the real world, that no bank or broker or government can make disappear with the click of a button. You want to allocate 10 to 15% of your liquid net worth to physical gold and silver, and you want it stored in allocated multi-jurisdiction vaults, meaning your metal is specifically identified as yours and it's not all in one country. Why physical metals? Because they are the oldest and most reliable form of wealth insurance in human history. When currencies collapse, gold doesn't just hold its value, it explodes in value. In the 1970s, that 24x move I mentioned. In the 2000s, gold went up roughly 7x. And just recently, gold is up about 70%, and silver is up about 140%. And that's just the beginning of this cycle. Now here's the honest truth about gold. In good times, it underperforms. When stocks are ripping higher and everything looks rosy, gold just sits there. It's boring. Your friends will brag about their tech stock gains, and you'll feel like you're missing out. That's the price of insurance. You pay for it and hope you never need it. But when you need it, nothing else comes close. Here's how you buy it. You can go through reputable online dealers like APMEX or JM Bullion. You can use allocated storage services like Bullion Vault, where your metal is stored in professional vaults and fully insured, or you can buy from local coin shops if you prefer to hold some yourself. Stick with standard 1-ounce coins and bars, American Eagles, Canadian Maples, things like that. You should expect to pay a 3 to 5% premium over the spot price, and that's normal. What you want to avoid is numismatic coins, the rare collector coins with huge markups. Those are for collectors, not for wealth preservation. The second investment is businesses with pricing power, and this should be the largest allocation in your portfolio at 30 to 35%. What do I mean by pricing power? I mean businesses that can raise their prices faster than inflation without losing their customers. Businesses that generate real cash flow you can live on. Businesses that own hard assets or irreplaceable intellectual property. Think about it this way. When inflation is running hot, most businesses get squeezed. Their costs go up, but they can't raise prices fast enough to keep up. Their margins shrink, their profits fall, their stock prices follow. But some businesses actually benefit from inflation. In the 1970s, energy companies with real oil and gas reserves saw their revenues explode by over 700% because the stuff in the ground was worth more every single day. Utilities passed higher costs directly through to consumers because regulators allowed it and because you can't exactly stop using electricity. Consumer staples companies like Procter & Gamble, Johnson & Johnson, and Coca-Cola raised prices on products people buy no matter what the economy is doing. You're not going to stop buying toothpaste because inflation is high. So how do you find these businesses today? Start with the dividend aristocrats. These are companies that have increased their dividend payments for at least 25 consecutive years. That's not just a nice track record, that's proof of pricing power. A company can't raise its dividend for 25 straight years unless it can consistently grow its earnings through good times and bad. Look for payout ratios below 60%, which means the company is paying out less than 60% of its earnings as dividends. That gives it a cushion to maintain and grow the dividend even if earnings dip temporarily. The sectors you want to focus on are consumer staples, so companies like Procter & Gamble, Coca-Cola, and Colgate-Palmolive. Utilities like NextEra Energy and Duke Energy. And healthcare like Johnson & Johnson and Merck. Build a diversified basket of 6 to 8 positions, roughly equal weight. Don't put everything into one company or one sector. Spread it out. The third investment is short-term U.S. Treasuries and cash equivalents. You want 20 to 25% of your portfolio here. I'm talking specifically about Treasury bills with maturities of 90 days to 2 years. Right now, these are yielding 4 to 5%, which means you're getting paid a reasonable return while taking virtually zero credit risk. You can also use money market funds that are backed exclusively by U.S. Treasuries. But the yield isn't even the main reason you want this allocation. The real reason is liquidity. When a crisis hits, when stage 8 arrives, asset prices collapse. Stocks go on sale, bonds go on sale, real estate goes on sale. And the only people who can take advantage of those sales are the people who have cash. Look at what happened in 2008. People who had cash on the sidelines were able to buy quality stocks and bonds at 50 cents on the dollar. Many of those investments doubled within a few years. The same thing happened in March 2020. The people with cash didn't just survive the crash. They used it as the buying opportunity of a decade. Now here's something important. Lock in these rates now before the Federal Reserve starts cutting. Once rates come down, you won't be able to get 4 to 5% on short-term treasuries anymore. To buy them, you can go directly to treasurydirect.gov and set up a ladder, buying bills with staggered maturity dates, so you always have some coming due. There are no fees when you buy directly from the Treasury. You can also use ETFs like SGOV for convenience, or invest through money market funds at Vanguard or Fidelity that hold only government securities. The fourth and final investment is productive real assets, allocated at 10 to 15% of your portfolio. By productive real assets, I mean things like farmland, rental properties, and infrastructure that produce essential goods and services: food, shelter, energy. Things people need regardless of what the economy is doing. This is the most tangible form of wealth preservation there is. In the 1930s, while stocks were down 89% and banks were failing, productive farmland held its value. In the 1970s, farmland doubled and tripled in price. And throughout all of it, the land kept producing income, crops still grew, tenants still paid rent, pipelines still moved energy. Now, I know not everyone can go out and buy a farm or a rental property. The good news is you can access these assets through REITs, which are real estate investment trusts. For farmland exposure, look at tickers like LAND and FPI, which yield around 3%. For diversified real estate, Realty Income, ticker O, has paid monthly dividends for 29 consecutive years. And VNQ gives you broad diversified exposure to the entire real estate sector. So let me pull all of this together into a clear portfolio allocation. Your core portfolio, which should represent 70 to 90% of your total investable assets, should be split across these 4 buckets: 10 to 15% in physical precious metals, 30 to 35% in businesses with pricing power, 20 to 25% in short-term treasuries and cash, and 10 to 15% in productive real assets. The remaining 10 to 30% you can keep for other investments if you want some exposure to growth or other opportunities. But the core has to be protected. Now, and this is critical, do not panic and try to do this all at once. Do not sell everything tomorrow morning and move it all in one day. That's how people make emotional mistakes. You need a systematic, gradual approach, and the speed depends on your personal timeline. If you're close to retirement or already in retirement, you need to move faster. If you're younger with decades ahead, you have a bit more runway. But don't use that as an excuse to procrastinate. Here's a simple step-by-step process. Step 1, calculate how many years you have before you actually need this money. Be honest with yourself. This determines how aggressively you need to reposition. Step 2, start selling the garbage. Look at your portfolio right now. Do you own meme stocks, speculative crypto, high PE growth stocks trading at 50 or 100 times earnings with no profits? Those go first. Then start trimming your broad index fund positions. Step 3, build your new positions month by month. In month 1, open a Treasury Direct account and make your first gold purchase. In month 2, start building your Dividend Aristocrat positions. Keep going methodically month after month. Your target is to have 70 to 80% of your repositioning complete within 6 months. Step 4, and this is the hardest part, ignore the noise. The market will go up while you're doing this. Friends will tell you you're crazy. The financial media will be screaming about new all-time highs. Ignore all of it. You are not investing for the next 6 months. You're positioning for a 75-year debt cycle that is about to complete its final stage. Now here's what I know is going to happen. Most of you watching this will nod along. You'll think, yeah, that makes sense. You'll feel motivated for about 10 minutes, and then you'll do absolutely nothing. You'll go back to your regular life, trust your financial advisor, and keep your money exactly where it is. And I get it. Your advisor seems smart. They have nice charts. They say reassuring things, but ask yourself this. Does your advisor make money when you hold gold? No. Does your advisor make money when you buy treasury bills directly from the government? No. Does your advisor make money when you sit in cash? No. Your advisor makes money when you're invested in funds that generate fees for them. Their incentives are not aligned with your safety. In 12 to 24 months, when this crisis becomes obvious to everyone, it will be too late. The assets I'm telling you about today will have already moved. Gold will be higher. Dividend aristocrats will be more expensive. Treasury yields will be lower. And the stocks and funds you're holding now could be down 50%. At that point, you'll be selling low and buying high, which is the exact opposite of what you need to do. So here's what I want you to do this week, not this month, not next quarter, this week. Pull up your portfolio, look at every single holding. For each one, ask yourself this question. Does this asset preserve my purchasing power during a period of high inflation and a debt crisis? If the answer is no, or if you're not sure, mark it for sale. Then sit down and write out a 3 to 6 month repositioning plan. Put specific dates on it, put specific dollar amounts on it, create a system with deadlines and benchmarks, because a system beats emotions every single time. Fear, greed, hope, these are the enemies of good financial decisions. A system removes them from the equation. Everything I've told you today is proven through history, not one cycle, not 2 cycles, hundreds of years of documented financial history. We are at stage 7 right now. Stage 8 is coming. And when it arrives, you will either be positioned to preserve and grow your wealth, or you will become a casualty. The choice is yours. Turn off this video, open your portfolio, and start today. 6 months from now, you're either going to thank yourself for taking action, or you're going to hate yourself for doing nothing. The clock is ticking.